Good afternoon, everyone, and welcome to the Daily Volatility Box report for October 31st, 2019. We are TOSindicators.com, home of the Volatility Box. For today's trading, we had a few different trades set up. So we had a trade set up on the DOW futures, which signaled to us the Dow was the more volatile of the bunch between the Dow, the Nasdaq, the S&P, and the Russell. But in fact, the Russell had actually told us in the first hour to expect more volatility around these markets. And so we'll talk about how we use that to determine our game plan to trade the Russell. We also had a trade in the 30-year bonds and then one trade in the crude oil futures, both of which paid you fairly nicely. So all in all, today we had a total of 3 trades. Over those 3 trades, all 3 were winners for a total P&L of positive $1,637.50. And this was sort of the idea of being patient, waiting for our entries, waiting for the edge, and trading only when we had those entries to really just have the probability stacked in our favor, the risk to reward ratio stacked in our favor, and really just be able to trade intelligently. On the calendar tomorrow, we have a few different events that call for us to be a bit cautious. So starting 5:30 a.m. Pacific, so 8:30 Eastern, we have non-farm payroll. And then later in the day, so 7 a.m. Pacific, we also have manufacturing numbers that come out. Now, last time we had both of these numbers come out, the market moved a bit more, and I believe it was off of that news that we then ended up having this whole idea of our red Forex factory folders just force us to change the conservative volatility box, and there might be something that you're looking to do tomorrow as well. So especially if we see non-farm numbers or manufacturing numbers that support that the economy is starting to slow down, then I'll be using the conservative volatility box, at least on the indices and the bonds, and then using that to try and fade either side's edges. If we have both of these numbers come out and we don't really see any sort of volatility at all around it, then that might be your excuse to try and use the aggressive volatility box if you're looking to be a bit more aggressive. But again, keep in mind it's a Friday. The past few Fridays have not been friends to us. We've had one nice positive Friday P&L, but then we've also had some really bad ones in recent history. And so I think using the conservative volatility box helps you at least stay protected and just try and trade with as many of the probabilities in your favor as possible. Also, we see later on in the day, we have a few FOMC members speaking. So let's just make a note of these members for the next slide, which is Clarida, Quarles, and Williams. And let's see where they stack on the overall chart of dovish and hawkishness. So this was a chart that was shared in the trade chat room with Danny and the folks from the Mr. Top Step trading room. And we see that we had Williams, more on the dovish scale, Clarida, more on the dovish scale, and then we also had Quarles, more on the hawkish scale. And this is just information. You may or may not use this to influence your trading decisions, but it's just nice to know where the members who are speaking are on the scale of overall dovish or hawkishness. And tomorrow we see we have 2 dovish really to 1 hawkish, and that just may give you an idea of how you're looking or what you're expecting the market to do. All right, let's start with the charts, and we'll first start with the S&P chart. And we'll approach all of these the way we approach all of our markets every single day. We start by drawing our line at that first 30 minutes after the market opens, and we check to see whether or not we breached either side's aggressive volatility box entry lines. We see in the case of the S&P that we very clearly hadn't. That was our sign to then continue to use the aggressive volatility box for the rest of the day. We then looked for any sort of moves towards the edges, which are determined by these blue cyan lines, and we look to fade them. So in the case of the S&P, we really just chopped around, but not at any of the edges, and the S&P didn't give us any sort of entries. If we switch over to the Nasdaq, we'll see something very similar. So we draw that same first line, and we check to see whether or not we breached either side's aggressive volatility box entry lines. We hadn't here, and that was our sign to then continue to use the aggressive volatility box, and once again, just chop sideways, right? No real edge, and so the Nasdaq was not a market in which we had any trade set up today. Now, however, if we come to the Dow, we did have a trade set up. So using that same model, we draw that first line and we check to see whether or not we breached either side's aggressive volatility box entry lines. We hadn't, and that was our sign to then continue to use the aggressive volatility box. And we started looking for entries at the blue cyan entry line. Our entry came as price fell perfectly, almost perfectly, into our cyan entry line. So our entry was right here. Our stop was outside of the volatility box where we had given it 85 points of room. And so if we just pull the chart up a little bit, our stop was outside of the volatility box, entry at the cyan entry line. And our first target was what we had risked. So that same 85, which was hit almost right away in this move up. So a no heat trade, you hit your target almost right away. You then moved your stop on the second contract to break even. And that second contract then for us ended up getting stopped out right here at break even when price reversed. And so we hit just our T1, but that told us that the aggressive volatility box was being respected. And we then started to look for our next entries. And for those of you that use like auto chartist or something else, I know a few of you just that have side-by-side comparisons, you notice that auto chartist stopped you out of your trade somewhere right around here, which is when we were just starting to look for our entry. And I think that's really just the power of having models that are a little bit more accurate and finely tuned. We look at different splices. We had a user ask us about this. And so we look at this data in a bunch of different splices. We then analyze those different splices. And that is what gives us these volatility box output ranges, which is what helps us capture moves like these and a reversal where we have price hold almost perfectly to a T with our volatility box. After this, we were then looking for our next entry on the volatility box, and we had an almost entry come here. So if you front run, then you ended up getting filled here. Our entry was parked at the 49 mark, and price ended up falling to the 50 mark right here in this candle. And so our entry was missed by just 1 point. I know a few of you front ran your entries because you emailed us saying you had 2 entries on the Dow, and that must mean that you had this front run. And if you did, good for you. You had a really nice reaction. For us, our entries were parked exactly at the blue sign entry lines, and so this missed us by exactly 1 point. And that was a bummer to see, especially on this nice reversal, which then ended up being your really nice reversal for the rest of the day and into the close. Let's now move on to the Russell futures. And in the intro, we talked about how the Russell signaled to us that it was a more volatile of the markets, right? And so if we use that same first hour test, we'll draw our entry line. We check to see whether or not the the Russell breached either side aggressive volatility box entry lines. And we see here that we very clearly had. We had here, and really that happened when price fell into our volatility box, which then makes it seem like we had breached the upper end of the volatility box. But either way, we had breached the volatility box. Now in this case, we're looking to see if we could have a move in the opposite direction if this were a normal trade and not in that first half hour of the market opening. We did not have that same opposite thrust, and instead the Russell ended up sinking down lower. And to us, this was our sign to then switch on over to the conservative volatility box, since the Russell was experiencing more volatility than we're typically used to seeing it experience. Now, unfortunately, that was a bit more cautious of a move than we required today, because price then later it fell perfectly into our aggressive volatility box and gave us almost a picture perfect reversal for the rest of the day. And so for an aggressive trader, you may or may not have caught this. For us, we were on the conservative volatility box. And if we look at that same area on the conservative volatility box, we didn't come close to having an entry on either side's aggressive volatility box entry lines. And so if you were using the aggressive volatility box on the Russell, you had a really nice reversal today. And if you were like us using the conservative volatility box, then unfortunately you missed that reversal, but you did have trades in the Dow and crude that set up along with the bonds. So let's move on to the bonds next, and we'll go back to our aggressive volatility box. We draw our same volatility box entry line, and we check to see whether or not we breached either side's aggressive volatility box entry lines. We very clearly hadn't, and that was our sign to then continue to use the aggressive volatility box. We had, once again, an almost picture-perfect entry that gave us a nice reversal on the bonds. So the bonds ended up falling right into our volatility box entry line. Our entry came right here, and our stop was outside of the volatility box where we gave it 5 ticks of room. We ended up hitting not only that first 5 ticks, but then we also ended up going to our second target, and that gave us both a T1 and a T2 on the bonds. And this was then an end of hour edge entry, and so our orders are canceled at this point, but it is free information. And we saw that once again, we were respecting the aggressive volatility box, and then we continued to drift down lower. This was not a valid entry for those of you who may be wondering, because at this point, the lower end of the volatility box is actually plotting right down here, since we're using this as our high and this as our low. And so using this high, the aggressive volatility box was plotted a little bit below where it was currently plotted. We then had an opportunity to go short. However, at this point, this is when the markets are looking to close. I'm not really sure what kind of follow through we're going to get. So this was not an entry that we were looking at. But if you did take this, then you also had a second entry that gave you a really nice winner in the bonds. For us, towards the end of the day, that's not really when we're looking for new entries. And so we skipped on this trade, but this was a valid trade. This was a trade that ended up giving you both your T1 and your T2 and would have helped you end the day up even nicer. And finally, let's take a look at the crude futures. So using our aggressive volatility box, we check to see whether or not we breached either side's aggressive volatility box entry lines. We very clearly hadn't. That was our sign to then continue to use the aggressive volatility box. Now our one cautious sort of sign, and this is that experiment that we've been running, is we had our volatility box give us that alert using that pattern that we've observing that we have a likely move trending down lower, at least for the near term. So we ended up pulling back, and then sure enough, almost like you had your chair pulled from beneath you, crude just fell perfectly into our volatility box entry line. This is then the point where we think price may have exhausted, and we were looking for a reversal. Our entry came as we tried to catch this reversal, and then we started to just chop down, right? So you had a few different times to enter. We chopped down lower, almost consolidated like movement, and so you had plenty of opportunities to get in. Our stop was outside of the volatility box where we gave it 20 cents of room, and our first target was that same 20 cents. And so we had that follow through almost right away. And then we were looking for our second contracts to hit that T2 level, which we got close to several times. So that second contract we got pretty close to hitting. And if you took it off at that point, fantastic. Otherwise, you could have taken off your contract into the close for a really nice gain as well. And so for us, that was a trade in crude. If you had not taken off your second contract, then your stop is still at break even and you're making your way well up to that pure second target line if you had missed it this time around. All right, so once again for today, we had a total of 3 trades that set up for a total winning rate of 100% and a total P&L of positive $1,637.50. And this is with taking a smaller crude profit and missing that second Dow trade because we hadn't front run our trade, and also being a bit more conservative on the Russell futures. So if you're a more aggressive trader today, then you had a much nicer P&L, and that is awesome to see. And I know a few of you emailed us just really happy with the day's profits, and that's awesome to see. Celebrate your profits. Be careful about Friday. Just make sure you protect those profits. Fridays have been known to steal some of our profits in recent times. And so that's something I am wary of. We went over our game plan for trading tomorrow. A lot of reasons to be cautious and use the conservative volatility box. And that might be the game plan that we look to follow. All right, take care, everyone. Good luck trading tomorrow, and we'll see you in tomorrow's nightly update.